Mohamed, let's start there. Team Transitory, how much of a challenge are they getting from the recent incoming data?
Massive, John, and thank you for having me. A massive challenge. I think anybody who looks at what's going on will tell you that unless you embrace the analytically meaningless phrase of persistently transitory, which I've heard, persistently transitory, this inflation round is not transitory. We should take it seriously, and central banks should move quickly to contain what could be something that ends up being more than just an inflation problem, but a growth problem.
Mohamed, how small is that window to act, to make that change?
It's there, John, but it's getting smaller. You've heard me say this for the last 5 months. The longer you wait, the harder it is to deliver a orderly adjustment. I think this notion that Andy Haldane introduced last July of a handbrake U-turn, what you want to avoid central banks doing, this handbrake U-turn, is a risk that we should factor in, and indeed is being factored in away from the Fed right now.
Mohamed, one of the more interesting aspects of the price action, we talk about the lift in markets following people bringing forward their expectations for rate hikes for the end of asset purchases in the middle of next year. Now we are pricing in potentially 2 rate hikes by the end of next year. Is this basically a market endorsement of a more hawkish Fed than has previously been communicated?
Yes, I mean, the market is telling the Fed 2 things. One is, get going with tapering, we can take it. And 2 is, you're not going to be able to separate cleanly tapering from rate hikes. And again, look at the numbers today. Look at PPI in China. This is a very hot inflation environment, and the longer the central banks wait, the greater the risk. And the market realizes this, and it's starting slowly in the fixed income space to price that in.
Mohamed, what would you say to people who argue that there is a self-correcting mechanism here, that higher prices will slow growth, will slow demand, and that you'll actually right-size without the Fed interfering and curtailing growth that needs to hit some sort of acceleration pace so we can get out of the hole?
I will tell them that in theory you're right. In practice, we haven't seen it work too well. It's a very finely balanced, because this is about demand destruction. That argument is about demand destruction. And when you destroy demand, there's a lot of collateral damage and unintended consequences. So in theory, in a textbook, it works fine. In practice, we often overshoot and end up in a recession. So this is not something that I would like to try as someone who cares about the well-being of Americans, and especially those who are lower income, because they get hurt the most in that sort of world.